Hi, I'm Matt Stoller, author of Monopoly-focused newsletter Big and an antitrust policy analyst. Now, I have a great segment for you today on this big breakdown. I'm going to talk about credit cards and the payment system in the US, how we pay for things, which, when you compare it to almost everywhere else in the world, pretty much sucks. And I'm going to explain how part of it has to do with those nifty reward points for credit cards and why they're a little bit of a scam. They're a means for credit card companies and banks to maintain market power and overcharge us, even though they look kind of cool when you're a consumer. Okay, so let's start with how you pay for things in other countries. I'm going to pick a country that is not typically known for its high-tech sector, for good government, for its ease of use in paying for things. I'm going to pick the country of Brazil. Tropical paradise, but tends to be considered corrupt. However, in 2020, the Brazilian central bank did something remarkable. They introduced something called an app called Pix, which lets anyone pay for things using a phone, basically for free. Now, it was a tremendous success. And today, Pix is not only more heavily used than credit cards and debit cards in Brazil, but it's so popular that the president of Brazil, Bolsonaro, is running ads for his re-election campaign showcasing the app. Imagine that. It's a political success story so powerful that the president of Brazil is saying, I got you a payments app, and that's why you should re-elect me. Beggars on the street actually are getting more money from Pix than cash. It's that convenient and that cheap. Now, I picked Brazil, but it's not just Brazil. Kenya, for example, has had a mobile payment system that is better than the US system called M-Pesa for almost 10 years. India has a real-time payment system that is as good or better than that in Brazil. And across Europe, the idea of writing a check or using a credit card with a signature is just plain weird. It's anachronistic. It's like living in the 1970s. But in the US, our system is slow, it's expensive. If you're a merchant, you have to buy, a payment processing machine, so it's bulky. It's just bad. Okay, so this begs a question. We have high technology in this country. Why haven't we moved to a better system? Well, there's a number of reasons for it. One is we're just used to credit cards, and we built that high-tech system, which was high-tech in the 60s. But more importantly, credit cards, this whole system in the US is insanely profitable for banks and credit card issuers, roughly 4.5 times more lucrative for the lender than any other form of credit. And if you add up the two main streams of revenue of credit cards, the industry generates about $257 billion in revenue every single year. That's $780 for each person in America, every man, woman, and child every year. And that is a lot of revenue to protect. Now, of course, it's not like they're just generating this revenue. They're getting this revenue from us. So it's not like, oh, this is a job-creating thing. No, it's just they're getting a lot of revenue, whereas in other countries, people don't have to pay for this because it's kind of done more efficiently by the government in many cases. Okay, so who protects this revenue stream? And how does the American payment system work? Let's start with the basics. Credit cards are two products combined into one. The first is access to a global payments network that lets a customer and a merchant transact. You know these networks. The payment network is super useful. It's MasterCard and Visa. You can pay at millions of establishments around the world. You buy online. You often don't have to convert to local currency. If you're a merchant, you can get paid by hundreds of millions of people. And for consumers, it seems mostly free. All you need is to carry around a piece of plastic. But it's not free. In America, merchants have to pay between 1.5% to 3.5% to middlemen on every single transaction, sometimes more actually. And that amounts to between $61 billion to $137 billion a year. And that amount of money makes everything that you buy a little bit more expensive. These swipe fees, which go not only to Visa, MasterCard, or American Express, that's the third one, but also to issuing banks and processors, are essentially a private sales tax. Now, Visa and MasterCard control 70% of the market. Last year, credit card networks raised their swipe fee prices to merchants by 24%. And I say that and that amount, and that's important because it shows that they have immense market power. You can raise prices massively, even though you're already making money. It means that your customers really don't have other options. So where does this market power come from? Well, merchants, even big ones, cannot afford to not accept Visa and MasterCard. So they have to, in turn, accept whatever terms they are given by Visa and MasterCard to accept their cards. Now, one key to this market power are credit card rewards, which are the points you get when you spend money through a certain card. And I'll get back to why that makes it so that merchants have to accept these cards in a second. Okay, these rewards recycle about $20 billion a year, mostly going to high-income customers and coming from the poor. So what's happening here is that the swipe fees that merchants pay, some of that money, not the majority of it, but some of that money is returned to customers in the form of reward fees. But actually, it's a recycling mechanism that taxes the poor and rewards the wealthy. This is from a quote from the Boston Fed, which says that the lowest income households pay about $21 a year and the highest income households receive about $750 billion a year from this system. It's a wealth inequality generating machine. Now, naturally, the credit card networks and banks, they keep a lot of the swipe fee money, but they pass enough of it back to us cardholders to make cardholders more loyal to our credit cards. Now, almost everyone would be better off if swipe fees were lower than they are, if this whole transfer mechanism didn't happen. But that's not obvious to users of credit cards who see a direct cash benefit, reward benefit, and so that ensures that they will continue to use their card, and therefore that merchants will have to accept their cards. Merchants are largely powerless in this arrangement. If you don't accept Visa or MasterCard, then a lot of customers just won't be able to pay for things at your store or your establishment. So Visa, American Express, and MasterCard even prevent competition between the three networks. They have what are called anti-steering provisions in their contracts with merchants. So merchants are not even allowed to distinguish between different cards to their customers. It's why you don't see signs that say, use Visa and get a discount in local stores, or you don't see the credit card fee broken out separately. And this is even though Visa's swipe fees are actually cheaper than American Express, they're not allowed to say that. Now, such a practice, these anti-steering provisions, should be illegal as antitrust violations, but they are not. In fact, there was a big antitrust case, a very important case, and after years of wrangling, in 2018, the Supreme Court basically gutted antitrust law and legalized this particular practice. Now, the second revenue stream for credit cards comes from credit products that allows a consumer to take out a short-term loan by carrying a monthly balance. There's value here. Sometimes you do need a short-term loan. It's convenient. But Americans overpay dramatically for the privilege, roughly $120 billion a year in total. Some of this overpayment is in the form of fees, like annual fees, fees for cash advances and balance transfers, rebates, minimum finance charges, over-the-limit fees, late payment charges, and so on and so forth. In this part of the industry, as with swipe fees, there is also market power at work. That's what happens when people are overpaying. It's because there's a lack of competition. There's something wrong with the market. Now, since 2005, there have been 6 firms who control roughly 2/3 of total balances: JP Morgan, Citibank, Bank of America, Capital One, Discover, and American Express. Now, I'm going to show you a sort of complicated chart, but it's basically the profit margin for credit cards. And you see it has gone way up since 2011. According to the Consumer Financial Protection Bureau, which is one of our bank regulators, from 2015 to 2019, the average assessed interest rate on credit cards increased by more than 20%. So that's from 13.7% to 16.9%. And this was when the prime rate, which is linked to what the Federal Reserve gives to Wall Street in terms of what Wall Street can borrow at, went up by just 2.25%. So that's what happens when there's no competition for borrowing. Just the interest rate and fees go up. And how does this work? Well, there are a number of mechanisms that credit card banks use to block competition and get away with such a high margin. So first, some banks withhold information to credit bureaus about borrower repayments, which makes it hard for competitors to try to lure those customers away with better offers. So second, it's actually hard to get the price of credit card interest rates. You often have to apply to get that price. And that means when you apply for a credit card, you get a credit check, which reduces your credit score. So shopping across offers just doesn't make sense. What happens is consumers look at rewards and annual fees, which is what credit card banks want them to look at, instead of interest rates, which is what matters. So it's just hard to get the price. Now, third, it's hard to refinance a credit card balance and switch cards. And fourth, credit card banks use sort of a lot of hidden fees that are called junk fees. So, for example, $14 billion in late fee penalties alone in 2019, especially on people with worse credit. Now, I could go on and on about the problems here, the problems with credit cards and payments. There's all sorts of surveillance issues and issues with who Visa and MasterCard decide to kick out of the payment system, due process questions. But there are even monetary policy consequences. So, for instance, when we hear in the news that the Federal Reserve is cutting or lowering interest rates, what they don't say is that it is interest rates for Wall Street. You and I, with credit cards, do not actually get charged less money when interest rates go down. If there were competition, we would, because there's a market for money. But there isn't competition, so the credit card banks can just sort of keep the prices high. Now, when interest rates go up, of course, they raise their interest rates. But they have market power. Now, the good news here is that none of this is inevitable. It's all fixable, and there is actually policy movement. So Senator Dick Durbin, who's a Democrat, along with Republican Senator Roger Marshall, just released a bill to foster more competition among credit card networks. So that's on the merchant side. And the politics here is not unstoppable either. Every merchant in the country, from firms like Walmart and Amazon to the small merchants, are angry about excess fees that they must pay. So the politics here are not actually insurmountable. Also, bank regulators at the Consumer Financial Protection Bureau are investigating these practices, and they're asking the six big credit card banks for information about potentially unfair practices. They're also using their authority to block junk fees by banks and considering ways to make it easier to switch credit cards. This is having good consequences. I found a story from Bankrate sort of showing that, and it's asking, will your credit card late fees go down despite inflation? And that's good. And that is actually the power of regulators when they work on our behalf. But most importantly, the best news is that the Federal Reserve itself, and I'm not a huge Fed fan, but this is very good, are actually trying to build a real-time payments network called FedNow. And FedNow is as close as the U.S. has gotten to something like Brazil's Pix network. It is supposed to launch next year. It will enable cash transfers and bill pay that settles instantly. Now, having the government do FedNow makes a lot of sense because payments are a public service. If I hand you a $20 bill or write a check for $20, you get all $20. No special equipment needed. The government takes care of all the counterfeiting risk. That is a public system. So our payment system is, in part, a public system. One of the original purposes of the Federal Reserve was that it would actually do this. The central bank would actually do this for the high-tech payment technology of the time of 1914, which was checks. And it worked. After the Fed was created, checks cleared at what's called par, which means that if you wrote a $20 check, you'd get $20. And before the Fed actually started check clearing, banks would take a fee for cashing a check from a different bank, very similar to a credit card network. Now, the fact that credit card companies and banks charge each of us $780 a year is a relic of 1960s technology, lax competition policymaking over the last 40 years, and political corruption. Even now, big banks are lobbying to destroy bank regulators who are trying to stop them, and systems like FedNow. And this brings me finally to something that I think a lot of you are going to have questions about, which is the role of crypto. Now, a lot of the people in the crypto or fintech world look at the inefficiency of payments and say, we need to disrupt it with new technologies and business models. But if that were so, we would see the same inefficiency all over the world, and you would need technology to address it. But in reality, this inefficiency is increasingly just an American problem, not a worldwide one. And it doesn't have to do with a technology problem. It has to do with dominant firms maintaining their power using political influence and monopolization. Where there are functional, effective governments, payment systems are quick and efficient. And where there aren't, payment systems are bad and clunky. So like it or not, this is a problem we actually have to fix through politics and government. Everyone else has, and there's no reason that America can't. So thanks for watching this big breakdown on the Breaking Points channel. And if you'd like to know more about big business and how our economy really works, you can sign up below for my market power focused newsletter, Big, in the description. Thanks and have a good one.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.